Okay. Lovely. Okay. Hi everyone and welcome to our June webinar. We've got Kat with us today to give her a presentation on advanced pension tactics. We believe that the presentation itself should last between 25 minutes to half an hour, obviously with a chance to ask any questions that you have for Kat at the end. Just pop them over into the Q&A box that should be over on the right hand side, and we will go through those with you all at the end. Otherwise, Kat, I will leave you to it.
Thank you, Jess. Okay, hi everyone. The title of today is Advanced Pension Tactics, and what we're going to be talking about is strategies which I don't think are going to be unfamiliar. No new territory here, for want of a better term. We're going to be talking about legislation that's been in practice for a couple of years, but refresh on the annual allowances, the rules around carry forward, and the tapered annual allowance as well. Okay, so as always, disclaimer as normal, this is for information purposes, and we recommend seeking personal financial advice for anything that's relevant to your own planning. So agenda for today, I'll start by highlighting something I'm not going to be talking about because I'm sure everyone is thinking about the inheritance tax rules with pensions. It's been in the media an awful lot in the last couple of weeks, mainly talk around whether it will go through or not. Our advice is to believe what we know so far from the budget. We're waiting for the finance bill still, which will legislate the introduction of pensions as part of the IHT regime. But I'm not going to be covering that today until we get more information. But our assumption is that the legislation will go through as proposed, and we'll be pleasantly surprised if anything changes on the contrary. So what I will be covering is running through the pension annual allowance and what's changed in the last couple of years. We'll be talking about pension carry forward and the scope for putting more into the pension above the annual allowance. I'll be covering the pension tax trap, so the tax trap relevant to those earning between £100,000 and £125,000 a year. Penultimately, we'll move on to the tapered annual allowance and who's impacted there. And finally, I'll spend a little bit of time talking about the pension versus ISA debate. So apologies, some of these slides are really text heavy, but we'll run through each of these areas and I'll use examples where relevant. So to begin with, the pension annual allowance is essentially the cap on what we can save into our pensions to be eligible for tax relief and avoid the cost of a charge for saving into your pension. So this dictates how much you can pay into your pension, but it also covers your employer and any third-party pension contributions. So a third party would be an individual who's not yourself and not your employer. Sometimes we use this in the context of parents looking to gift to their children, paying into their pension, for example, all of which forms part of the pension annual allowance. Now, the annual allowance for the current tax year and for the last two has been £60,000. So £60,000 is our standard annual allowance, but it's worth noting that that is only relevant if you earn £60,000 or above. Otherwise, you're capped at your earned income. So, for example, if someone earns £30,000 a year, that is their personal annual allowance. But if someone earns 70, 80 or 90, their annual allowance is £60,000 a year. And that's the gross number. So when we contribute personally to our pensions, we pay in 80% of the gross contribution. So 60,000 applies to the gross number. It's also worth noting if someone is a non-earner and they've got scope for pension contributions still, again, a strategy we used to use a lot for inheritance tax planning, but there is a non-earner's contribution rate of 3,600 gross or 2,880 net. Now, ignoring carry forward, any contributions that are paid in over the annual allowance incur a tax charge. It's referred to as an annual allowance charge, and you're essentially penalised at your rate of income tax. So for someone who has no carry forward space and they put in £80,000 into their pension, they would have breached their allowance by £20,000. and they will be charged, assuming a 40% tax rate, 40% on the 20k. And that's paid on self-assessment unless they qualify for scheme pays, which I'll come on to in a moment. Now, in order to understand what you've paid into your pension, if you've got a defined contribution pension, it's quite simply the amount that's gone into the policy. It's slightly more complicated for defined benefits, which I'll show you on the next slide. But it's also just worth bearing in mind that if someone has taken benefits from a defined contribution pension flexibly, that means they've taken income from a pension. You can ignore everything I've just said because you're only capped at 10 grand a year. So just to come back to the point I made on defined benefit pensions here, which is my third bullet point. The calculation for how much goes into the pension for a defined benefit scheme is slightly less simple. And that's because there is no value necessarily that goes into a defined benefit scheme. It's an accrual-based benefit system. So the way that we calculate someone's pension annual allowance for a defined benefit scheme is that we take the opening value of the pension times 16, we add in CPI, we take the closing value times 16, and we take away the difference. So as you can imagine, that's not data that you can typically get in the current tax year. So for those with kind of still quite healthy defined benefit pensions, we normally have to plan a year behind. So that's where we will use carry forward quite heavily, which I'll come on to in a moment. Now, it's just worth noting that the annual allowance tax charge doesn't apply when someone is in severe ill health. So under the previous system where pensions were exempt from inheritance tax, if someone was terminal, morbidly, they could put a significant lump sum into their pension. That money would be immediately inheritance tax free. And it would be a non-chargeable event for the annual allowance. Again, that's not relevant now, but there was a bit of a loophole, for want of a better term there. But again, still doesn't apply if someone is in severe ill health. There is also a very odd bit of legislation under the Armed Forces Act, where certain members of the Armed Forces are exempt from the pension annual allowance. Finally, it's just worth noting that if someone pays into a pension in error, if it's miscommunication with an employer, we typically have a cooling off period which can apply, and HMRC will rebate on a genuine error. But it's always worth, if you think you've made a mistake, getting in touch with your pension provider immediately to avoid being charged on the contribution. Now, I mentioned scheme pays very briefly a second ago, and scheme pays is essentially a system for those who have breached the annual allowance to not pay the tax charge directly on self-assessment from their cash, but instead to reduce the value of their pension. So this is applicable for anyone who's breached the allowance by more than £2,000. And essentially, if you've got a defined contribution pension, you reduce the pot size by the amount that you've breached the allowance, or the tax charge applicable, sorry. And if it's a defined benefit scheme, they reduce the income using a scheme pays calculation. So typically for most people, this is the right course of action, to be honest. One, because it keeps their cash balances healthy and it's not a cost for them at the end of the year. But two, because the pension will be taxable on exit. Therefore, we typically see this be the most tax efficient way to reduce your estate to pay the bill. Now, it's worth noting that not all schemes allow voluntary scheme pays. So it's always worth getting in touch with your pension scheme if you are in this situation to see if you can use scheme pays with them. Of course, it has to be the pension that you've breached the allowance with. So it can't be that you've got a Aviva and a Fidelity pension, you breach the allowance with Fidelity and you pay with Aviva. It has to be the scheme applicable for the breach that you take the reduction from. And finally, an annual allowance breach using scheme pays for payment still needs to be noted on your tax return. So you note there that you have used scheme pays, but HMRC still need that recorded. So if you have breached your annual allowance and you're not familiar with scheme pays, reach out to your advisor or reach out to your pension scheme, because in most cases, it's a very beneficial tool to use. Now, I've mentioned the standard annual allowance so far being £60,000, again, capped at earnings otherwise, or capped at £3,600 for non-earners. But there is another bit of legislation that was introduced in 2016 called the tapered annual allowance. And this was essentially introduced to try and limit the ability to claim tax relief for high earners. And the restriction came in at quite a low level, if I can say so, in 2016. Previously, it was applicable if you earned over £150,000, but thankfully it's risen quite nicely over the years. So the tapered annual allowance applies for those whose adjusted income is over £260,000 a year. Now, their adjusted income is simply their PAYE income, any other income from, say, rental properties as an example, and all pension contributions. So that's employer and employee contributions. So the test is done on adjusted income, but you only need to test if someone's threshold income is over 200k. And simply your threshold income is all income, but excluding pension contributions. So if you're someone who's making quite big pension contributions, it's worth bearing in mind that that will impact your adjusted income, and therefore, your carry forward calculations accordingly. But the rule of thumb is if you earn over 200,000, you've got other sources of income, you could be impacted by the tapered annual allowance. If you earn over 260, you definitely will be impacted by the tapered annual allowance. Now, what the tapering means is that essentially if you earn over the adjusted income level of 260, you will lose £1 of your standard annual allowance for every £2 you're over the threshold. So, for example, if you earned £270,000, you would lose £10,000. You would lose £5,000, sorry, of your £60,000 allowance. If someone is earning over the 260 threshold and they go over then the 360 banner, they are completely capped at a maximum of £10,000 thereon. So that's someone earning 361 and someone earning 3.6 million. Regardless, they will be capped at £10,000 a year. And just to stress, that is employer and employee. So people who are in the tapered annual allowance, you just have to bear in mind your employer contributions and make sure that each year you are planning accordingly to ensure you're not breaching the annual allowance, unless you've got scope for carry forward. And just to highlight, this has changed quite significantly over the years. So I've put in a table here that Royal London kindly provide to give a breakdown of the relevant dates. So the introduced annual allowance came in April 16, at which point we had an adjusted income of £150,000 and a standard annual allowance of 40. They then revised the rules in April 2020 when we were all very busy with COVID, and they increased the adjusted income to 240, and they reduced the minimum annual allowance to 4. That then changed quite quietly again in April 23 to bring in our current rules. This is when we had our annual allowance of £60,000 overall, and our adjusted income came up to 260, and the minimum allowance came up to 10,000. So this change caught a couple of people out. I still hear some people talk about a £4,000 cap if they earn over the maximum threshold, but it is now 10. So there is potentially a bit of scope for using that unused allowance if you've still kept your allowance at, if you still kept your contributions at 4,000 a year. So just to give a worked example, I've got an example here of someone called Jess, who has an employment income of £240,000 and a rental income of 20k, and her employer has paid £24,000, 10% into her pension. So we know that Jess is over the threshold income, so we now need to calculate her adjusted income. And we do that by taking her PAYE income plus her rental income plus her employer pension contributions, and we come to 284 as her adjusted income. Jess's annual allowance is then reduced. It's reduced as such. We take the 284 minus the 260, our threshold, and we divide that by 2, giving us £12,000. that £12,000 is taken away from the standard annual allowance of £60,000, leaving Jess with an annual allowance for the 25-26 tax year, of £48,000. Now, as we know, Jess has already received £24,000 into her pension, which was her employer contribution. So she can personally pay in the difference. £24,000 is therefore available. Hopefully that visual makes sense, but it's just to highlight how the annual allowance is reduced and to consider that money's already gone in from the employer. Therefore, Jess's personal scope for pension saving is reduced as well. And then finally, if Jess's income did come over that £360,000 with something like a big bonus payment, she would be capped at the £10,000. And you might see a bit of a risk here, because if someone is in a high paid role that results in a standard base income and a bonus scheme, and they are already in that adjusted income of over 260 banner, they might find that they breach the annual allowance by mistake due to their bonus coming in. And if someone knows they're going to get quite big bonuses, we may advise that they actually use the £10,000 base contribution level and instead review a pension contribution with their bonus at the end of the year to avoid going over. Or we might rely on carry forward from previous years and try and manage and monitor that quite closely as the year goes on. But quite a typical scenario we see is that people get bonuses paid in March, which makes it very difficult to predict what their income will be for the year, and therefore very difficult to know just how impacted they're going to be by the tapered annual allowance. So if you think you're in that category, it might be sensible to cap at 10 automatically and review it annually. And in some instances, I see very nice employers who will reward you with increased income for taking a lower pension contribution, or potentially things like shares. So always worth a conversation if you are in that category of investor. Now, if you have a UK pension, you are entitled to do something called pension carry forward. This is essentially where you can take unused annual allowance from the previous 3 tax years and carry them into the current tax year. Now, you don't have had to have paid into a pension at all. You just have to have been a member of a UK registered pension scheme. So even if you'd left the country, you weren't even working in the UK, but you had a legacy pension, you're entitled to use carry forward, which is a great system, but unfortunately not applicable if you've never even opened a scheme historically. So carry forward allows us to look back at the last 3 years, entitled for those who have used their current tax year's allowance. So you can't use, for example, 23-24 without using 25-26 in the current tax year example. And this is a really good tool for those who are in that position I mentioned earlier, where they have quite large commission or bonus payments at the end of the year, and they can't quite manage what their annual allowance is going to be. Instead, they can do the bare minimum in the knowledge they can carry forward from that year in the following year. Now, if you are someone who has already taken income flexibly from your pension, you are in what we call the money purchase annual allowance restriction, and therefore you cannot carry forward. So carry forward is only available if you're a working individual and you are not, you've not taken from a pension scheme before. To give you an example, I've got an illustration here of a carry forward calculation for someone who has been kind of close to or over our adjusted income figures. So my example of Jess. And what this table is showing us is the relevant tax years. So we've got our current year looking back 3. And I've illustrated what the standard annual allowance was for those years. So 22-23, the annual allowance was still £40,000 as standard. But from April 23, that went up to 60. Now, Jess's adjusted income, we can see here throughout the years has increased. And therefore, in 25-26, she has a tapered annual allowance, whereas in previous years, she still qualified for the full standard annual allowance. I've assumed Jess is making 10% pension contributions throughout the years, so we can see on this line here how much she's paid into her pension. and therefore how much of her annual allowance is unused. So simply we've taken the tapered annual allowance less the contributions paid to give us her unused allowance. And this shows us that overall in the 25-26 tax year, Jess could pay £129,000 into her pension, gross of tax relief. And as a reminder, Jess's contribution of that is 80% if she paid in personally, whereas if Jess had a limited company or an employer who was very generous, they would pay in the gross amount, the £129,000. Now, for some people, that's affordable. For other people, that's quite a hefty number that they might not be able to do in one go. A scenario where someone would be if they just received an inheritance or a redundancy or something like that, and we just want to get as much in the pension as we can. But for most people, if they've got carry forward, we want to try and use the current tax year and the year we're about to lose. And this is particularly important for people whose income is going to be rising, and hopefully their income will rise, but unfortunately they'll see their tapered annual allowance go down as well. So in this instance, Jess could use her current £24,000 available allowance, plus her 22-23 allowance of £21,000, which she will lose in April the next year. So, for example, that gives Jess the scope of saving £45,000 gross into her pension, which would cost her £36,000 as a personal pension contribution. So that means £36,000 leave Jess's bank account, £45,000 goes into the pension with HMRC tax uplift, and Jess would then log that personal contribution on her self-assessment, and she'd get a further 11 grand tax relief back. So carry forward is really, really beneficial for those who are in a position where they can save more. They're in a position where they have very heavy bonus income. So it's really useful if you're in that category to keep working with your advisor to have an accurate carry forward calculation throughout the year, so we can really simply see what you've got scope to do at the end of the tax year with any planning. And final note on this, carry forward is of course recorded on your tax return to give the tax relief back to you on self-assessment. HMRC sometimes ask for proof of your calculations. So again, that's why your advisor will normally ask for a statement from your provider to keep on file, just so that if you're asked the question, we can provide the data for you really quickly. Now, the tax trap. Hopefully you're familiar with what the tax trap is, but essentially the tax trap is applicable for those who earn over £100,000 a year. And this is because if you earn over £100,000, you start to lose your personal allowance. And this is a threshold that hasn't changed for quite some years. And I think it's a number a lot of people would like to see change, to be honest. Essentially, it's creating a 62% tax rate between 100 grand and £125,000 because of that loss of the personal allowance. So similar to how the tapering works on the annual allowance, for every £2 you earn over 100k, you lose £1 of your personal allowance. And the personal allowance is your tax-free income that you can have each year. So for example, if you're earning £110,000, your annual allowance has dropped down from £12,570 as standard to £7,570 with your higher income. So unfortunately, that then means the income that would have been taxed at 0% juts onto the 40% tax bracket. So it is essentially a 62% tax on any earnings between 100k and 125k. So this is really important for people who are working parents, essentially those who have children in nursery and they are claiming for the free hours. They can't earn over £100,000 taxable. So if someone's offered a pay rise and it just takes them over the 100k, it's often not very beneficial for them. And this is where pension contributions can step in to help reduce the effective income to under 100k, so they can maximise their allowances for things like nursery fees. Now, to give you an example, this is probably really small text on your screens. It looked good when I did it on mine earlier, but you can see here the example of someone who earns 100k compared to someone who earns 120k. And for example, our earner of 100,000, they've still got their full personal allowance. They've got their basic rate band and their higher rate band. And I've shown here what tax rate they're paying and what the effective tax charge is on that level of income. If someone earns £120,000, their personal allowance has dropped down to £2,570. And we can see their higher rate tax has gone up to account for the income that now needs to be taxed at 40%. So overall tax for someone earning £120,000, ignoring national insurance, is £39,000 a year. And we can see the overall tax rate the individual pays has risen from 27% to 32.8%. Now, if our earner of £120,000 had the scope for a personal pension contribution, they could regain their full personal allowance. So if they were to get £20,000 into their pension gross, it would be a personal contribution of £16,000 net. They would then what we call stretch their basic rate band. So the way the tax relief works is we would take their basic rate band of 37,700, we add in the gross pension contribution, and that would give us 57,700 of income taxed at the 20% rate. They'd also fully reclaim their personal allowance. Therefore, less income is taxed at the higher rate. Our 79,000 has now gone down to 49,000, and their overall tax charge is reduced from 39,400 to 31,400. So they're saving £8,000 on their self-assessment tax bill, which, as we remember, they've only contributed £16,000. The pension's got 20k, so the effective cost of getting £20,000 into their pension has been £8,000. So it's really beneficial for tax planning and for nursery planning for those in that category, but also to grow the pension with a nice healthy number with a low personal commitment. So if you're between that £100,000 and £125,000 mark, do consider increasing your workplace contributions first and foremost, especially if you're on salary sacrifice, you save on the national insurance as well, or personal contributions to get you back below that limit. Final area of discussion for today then is pensions versus ISAs, which is a really common question we get asked is, should I be paying into my ISA? Should I be topping up my pension? What should I be doing with my spare cash? And with all good financial planning, there is no perfect answer. It's very personal. It really depends on where you are with your needs, your age, your planning strategy, your access requirements. So first and foremost, do you need access to the money? If you can commit to not needing access until retirement, in most instances, the pension is the right thing to do. However, if you think you need access, if you think you've got to move on the horizon or work on your home or medium-term access needs, you can't commit to that 58 plus access age for many now, then in that instance, you need to be thinking about the ISA instead, or a combination of the two. I'm an advocate of financial planning in percentages, so spreading your spare liquidity each month or your spare capital each year in percentage buckets into different pots. So it could be that someone is putting 50% of their spare liquidity into their pension because they're in their 40s and that's their next big major financial outgoing. But they want to keep 25% squirreled for things like holidays and short-term costs, and another 20% for capital costs for things like their house renovation that they might do in a couple of years. So I think that strategy works well for most, but depending on your life stage, the debate of pension versus ISA depends on your access needs and your ability to regain tax relief. Now, from a taxation perspective, if you can afford to put your money away for retirement and not need the access, pensions are very tax efficient compared to the ISA. Of course, the ISA has no tax uplift, but it also has no tax on exit. So if you put in 10 grand, the ISA receives 10 grand, and then when you withdraw it, you get your contribution cost back. But essentially, £10,000 is what you see, it's what you get. but any growth that the ISA has made is tax-free. The pension, on the other hand, gains tax uplift. So if you put in your £10,000, the pension will receive £12,500, regardless of whether you are a basic rate taxpayer or an additional rate taxpayer. If someone is in that higher category, however, they will also get tax relief. So, for example, someone earning over £50,000 or £60,000 technically with their pension contribution, they can get £2,500 relief on their self-assessment. Therefore, the cost getting 12.5 grand in their pot has been £7,500. However, when someone comes to access that 12,500, they will be liable to tax on some of that withdrawal. To break that down, if we assume that someone's got £12,500 in their pension and it's not grown, and they're withdrawing that as a single withdrawal, they will get 25% of that withdrawal as tax-free cash, and they'll pay tax on 75% remaining. This is, of course, applicable if someone still has their lump sum allowance remaining. That's the cap on how much tax-free cash you can have in a lifetime, which simply is £268,000. If someone goes over that tax-free cash withdrawal limit, whatever you take out the pension is taxed. So I've shown here 3 different taxpayers: a basic rate taxpayer in retirement, high rate taxpayer in retirement, and additional rate taxpayer in retirement. And I've assumed all of them have used their personal allowance or lost it. So, for example, our basic rate taxpayer, to withdraw their £12,500, they will pay £1,875 on exit. Higher rate will pay £3,750, and additional rate will pay £4,218 to exit the pension with their 12.5 grand. However, each of those investors have received tax relief on entry, which I've shown in this column here. So, for example, our high rate taxpayer, their cost for getting 12.5 grand in the pension was £7,500. So they've had tax relief either by uplift or rebate of 5 grand. So their tax benefit is £1,250. So hopefully that shows, even with the tax on exit, given the tax uplift and the tax relief on the pension contribution, saving into a pension scheme versus an ISA does work out to be really lucrative. The consideration is just the access, the age, and the planning objective. But as I say, if you're in that category of I don't need the access, most times we can prove that the pension is the more lucrative planning opportunity for you. Okay, thank you for listening there. I appreciate that was a really wordy block of slides, but hopefully you're able to kind of listen and take in the content. We'll open it up for Q&A, and then before we sign off, we're just going to ask if you've got any suggestions for our next webinar to give us some ideas. But I will have a quick read of your questions in the chat and answer those, and any other questions, please add them in.
We've just got the one at the moment, I think, from Paul. Let me, oh, actually, I've got another one just come through. Let me just see if I can put this up. So your annual allowance example did not mention benefits in kind. Do all of these count towards your income for annual allowance? Yes, yeah, I kept my example as simple as I could, but yes, any benefits in kind will be added in. So that is a really important point. And if you've got an income which is made up of multiple different sources, like benefit in kind, rental property, dividends, whatever that might be, I'd really recommend working through that with your advisor to get an accurate calculation. But in short, yes, they are included. Lovely. Also, just to mention as well, because Kat did say that some of the examples might show up a little bit small on your screen, we will be sending out a copy of the slides as well, so you can refer back to them if you need to, or have a little look through them on your own time as well. And then we've got this one from Paul. Hi there, Kat. I crystallised part 40% of my company pension 18 months ago, bought bonds. I'm still working as such. For the last tax year, my company was limited to contributing 10k. Is this correct, as I only crystallised 40%? And B, can I bring forward from the previous years my unused allowance? Thank you, Paul. So I'm assuming that when you crystallised the 40%, you took income from the pension as well, which based on 40% would be the case.
that means you are in the money purchase annual allowance. So you've taken income from a defined contribution pension, therefore you're capped at the £10,000 contribution, unfortunately, for forever whilst you're working. And unfortunately, for those who are in the money purchase annual allowance, they can't use carry forward, which I think is a little bit harsh personally, but unfortunately you are now capped at 10 grand a year. So it would be a case of saving towards retirement with other vehicles, which that's when it's great to fill the ISA. Got scope for spousal planning, can be really good here as well. And the other product I would recommend talking to your advisor to replace pensions would be things like venture capital trusts, if you're a high risk investor, or offshore bonds. So there are ways we can save towards retirement that aren't just pensions, but unfortunately in your case, you're going to be capped at the 10 grand for the foreseeable.
Lovely. And then the defined benefit input charge, which month's CPI is taken into account?
Yeah, good question. This part's a little bit scheme specific. Typically, it's going to be the April end, so the year end CPI number. Most schemes change in April or January. The schemes that change in January are the awkward ones because we've got to account for a bit of a prorated CPI rate. But I'd say in the cases I see, 9 times out of 10, it's the April and the year end that we'd use.
Lovely. Those are all the questions we've got at the moment, but I'll wait and just see in case any more come through in the meantime. As Kat mentioned, we do have a survey that I'll pop up in just a second, and part of that survey is also to ask for your feedback and also any suggestions if there's anything that you would like to see in our webinar series. Obviously, we use this series to try and educate and feedback on anything kind of going on in the markets that you guys would be interested in seeing. So please do use that as well if you do have anything that you'd like to see any of our advisors bring forward as topics. So I'll leave that up now. We haven't had any more questions come through, so I'll leave that up for about 5 minutes. And if you do have the time, then please do leave that feedback for us. Otherwise, thank you, Kat. That was a really good presentation.
Thanks, everyone.